Joining us right now is James McDonald. He's the founder and CEO of Hercules Investments. And James, you think that we have kind of had our run with the good news we're seeing out of the vaccine. The markets have taken the most they can out of that. You actually expect us to turn down from here. Make your case for that.
Well, there are expected vaccine setbacks. There's supply chain slowdowns. And yesterday's allergy warning is something we need to pay close attention to. The stimulus hopes are fading. And we have never had a market run up this high for this long in history. We are at levels of valuations that have just exceeded those just prior to the 1929 crash, just prior to the dot-com crash in 2001. And even in a normal bull market, we would be ready for a pause here and for a correction. And in this current climate, the risk is probably stronger than it's ever been in history, given the COVID situation was what caused the market to come down after a record bull market from March 2009 to this February. And so there are just too many risks in this market relative to the run-up that we've had. And so it's time for the markets to stop going up and to come down. And I believe that when they do come down, they're going to come down really hard.
You're also a little concerned because the percent of the market activity that's made up by retail investors, the Robinhood traders and such, is fairly large, 20 to 25% on some days. What is it that concerns you about the retail investor playing such a large role?
Well, I think that market euphoria since November 9th, particularly due to the retail presence, is too strong relative to the risk in the market. Call option has reached a record high in November. Even though professional buying was flat on the Chicago Board of Trade. And now retail's 20% of activity on average and 25% on peak days. And this crowd doesn't understand the risks in the market. They understand that if they buy and they sell, they may make a profit. But when it stops, it can become very dangerous. We saw this back in 2001 as well, with rules instituted by the regulators for quote unquote day traders. And what we want to be careful of here is tech up 42%, consumer discretionary up 42% through this rally. Those are sectors that can go the other way very fast. And we want to be careful about chasing this. And the NASDAQ 100 up 42% year to date in a market that is extremely risky. These are all risks that we think need to be factored into a portfolio design. And where we are is very defensive here.
You say that you see a pullback between now and the inauguration day on January 20th to 34.85, and after that you look all the way down to about 3,200. That's a decline of more than 12% from where we are now. What's the one thing or two things that could actually change that could prop the markets up?
So only a stimulus bill or Fed intervention, I think, could push markets higher. But we've got extreme partisan tensions in Congress that make a stimulus bill before the year end unlikely. And divided Congress makes progress hard. Biden can still impact green energy, but we really think that the stalemate from our legislators is going to keep this stimulus bill. Probably it'll be a last minute thing. And when it does happen, obviously it'll happen because it must happen. And let's understand what the stimulus bill is, right? It's a necessary precaution to keep our economy safe. And in the face of the risk of the lockdowns, this is something that is also going to be a risk to growth in Q1 2021 and going forward. And I think there's too much optimism, given that what brought us down in the first place is back and we're seeing cases spike again. I do not think that this is something the market's going to continue to be able to shrug off.
Shepard Smith here. Thanks for watching CNBC on YouTube.